Welcome. In today's video, I am analyzing Gujarat Alkalies and Chemicals Limited. This is on a standalone basis, meaning I am not comparing it with other peer group companies. This is an analysis of the profit and loss account, the balance sheet, the cash flow statement, and finally the quarterly profit and loss account. So in this way, we'll look at different ratios, different line items of each account and try to analyze and understand how the overall health of the company is. We can also compare this company with its peer group and do a cross comparison as to which ratios are very different or in line with the peer group companies. So let us begin our analysis of the profit and loss account. I'll be generally analyzing the left hand side of the graph, and the right hand side would generally have the corresponding data of those analyses. As we go on, I'll explain what it means. Let us begin by looking at how the company's sales has been growing from last 10 years, 7 years, 5, 3 and the recent 12 trailing months. That is in the latest 12 months from the September 2019 month. So in the recent, I may not analyze all of these years, but generally I would analyze the 5 years and 3 years and look at the recent growth rate. The other two are for additional analysis if someone wants to do that. So the sales has been growing in last 5 years at the rate of 10.7% every year compounded. So there's a difference between the compounded growth and the average growth. In the last 3 years, the growth has further increased. The speed at which the company's sales has been growing is at 16.58%. So this is much better. And in the recent 12 trailing months, it has increased by 28.8%. This we can compare it, or we can analyze it by looking on the right hand side and seeing that in the recent 12 trailing months the sales was 3084 crores and in March 18 it was 2455 crores. So that's a growth of around 28.8%. So in the recent 12 trailing months, either I am taking the 2019 or 2018, whichever is higher. And as far as 3 years growth rate is concerned, we need the 4 years data. So from 19, 18, 17 and 16. So from 16 onwards till 19, we see a growth rate of 1995 crores in sales to 3161 crores. So that's a compounded growth of around 16.58% in last 3 years. And 5 years, as I mentioned already, it's 10.7%. So companies growth rate in sales is good at about 10%. So this is what we should be looking at, that the company is managing to grow its sales at more than 10%. Sales is a critical part that we should definitely look at, because this is the starting point from where the company's revenues are generated and all expenses are deducted. Next, we'll move on to looking at the operating profit margin. That is, how much was the top line profit after removing out the operating expenses that the company incurred from the sales it did. So from 15 onwards till March 19, we can see that the company's OPM has been consistently increasing till 35.28% in March 2019. And even in the recent 12 trailing months, the OPM is quite good at 30.9%. So the company is consistently increasing its sales, and its operating expenses are also not increasing at that similar pace. So it's managing to grow its operating profit margin. Again, when we are investing in a company, we want company's OPM to be consistently increasing. So OPM is calculated by taking the sales and removing out the operating expenses. So whatever remains is the operating profit. And then we can multiply that with 100 to get the operating profit margin. So the individual data is on the right hand side. So if somebody wants to understand March 19 operating profit margin is 35.28%. So how did it come? So we can go on the right hand side, March 19, look at the company's sales. This was 3,161 crores in March 19, against which the expenses, operating expenses itself were around 2,046. So that gives us a margin or a profit margin of 35.28%. So, proceeding on, I may not look at or explain each individual ratios, or at least the internal calculation of that. So, if someone wants to do that, they can look on the right hand side, pause the video, see the individual figures, and look at the percentage, because I am familiar with the percentage. So, I'll be quickly going through all these ratios. Let us look at the other income percentage, meaning out of the sales, how much there was other income generated by the company. So the company's income generation could be either through operating activities or through investing activities or through other income. So other income as such should not occupy a major portion of the company's revenue, because that can vary from one year to next year, and that can mislead us in terms of looking at just the total income and considering that in the profit or net profit. So we should generally avoid investing in a company which earns a big chunk of its money from other income, and if the company's other income is inconsistent, then that should be noted. So from March 15 onwards till March 19, the other income percentage as of sales was very flat at around 2% on average. Even in the recent 12 months, it's at around 2.97% of the sales. So just to analyze the March 19 data, the company's sales was 3161 crores, against which the other income contributed just 61 cr. And even if we look at from March 15 onwards till March 19 and the recent TTM data, it is somewhere between 49 and 106. So this is a consistent other income data, and it is not contributing much as compared to the sales of the company. Average OPM. Since last 10 years, the average operating profit margin the company has earned is around 23, and we can see even in the last 7 years and 5 years as well, it's somewhere between around 24 and 25%. In the recent 3 years, the average OPM is increased to 30.6%. This is good. What we are doing is we are taking the 3 years operating profit margin and taking an average of that. So 30% on average from last 3 years is a very good operating profit margin for any company. Let us look at the expenses. That is, generally these two are the major expenses along with R&D for most of the companies. The raw material cost generally occupies a major portion of the company's expenses or operating expenses. This is the expenses incurred on purchase of goods and raw material for manufacturing. Since March 15 till March 19, we can see that the raw material cost as a percentage of sales has been decreasing consistently from 34.9% to 27.3%. So the company is managing to control its raw material cost, either it is that way or the company's sales has been increasing consistently, which we saw earlier, that the sales has been growing steadily, and that is what we should be looking at, that the company is controlling its raw material cost. So 34% and even 27% is a very good figure. We also need to cross check the industry raw material cost for other companies. Employee cost also occupies a substantial portion of the operating expenses. From March 15 till March 19, again it is a similar trend where the employee cost as a percentage of total sales is decreasing consistently from 8.57% to 6.55%. What is the depreciation percentage as of sales? Meaning, out of the sales that the company has done, how much is the expenses on depreciation. One thing to understand is that this is a non-cash expenses, meaning no cash goes out as such, but it's just a book entry to reduce the value of assets from the balance sheet and show it as an expense in the P&L account. The depreciation helps us understand whether the company is consistently depreciating its assets and whether it is manipulating its P&L account. So when we look at the depreciation rate, we should see a stable percentage rate of the sales or on the sales. So that basically gives us an assurance that the company is not playing around with the depreciation numbers. So as we see, there has been consistently from March 15 till March 19, the depreciation rate has not changed much. So this is a good thing. If someone wants to look at the details of the depreciation and the sales, they can look on the right hand side. We can also see that the number wise also from 98, 107, 111, 127, 140, the depreciation has been increasing but at a very stable rate. It's not haphazard. So this is a good thing. Let us look at the interest percentage as of total sales or on total sales. So interest cost is very similar to the depreciation in the sense that we here again too we are looking at a consistent interest cost, and if the interest cost as a percentage of total sales is very high, then we should avoid that. So here company's interest cost as a percentage of sales is very low. In March 19, it was just 0.66% of the total sales, meaning the total sales as we saw earlier was 3,161 crores. On that the company's interest cost is just 21 crores. So the company's debt or the finance liability or interest payment liability is very low at just 21 crores and can be easily paid off. So number wise also, numerically also, every year although the interest cost has gone up steadily, but it's at a very mild pace and it is at a almost negligible level. Next, let us look at the tax rate percentage and as a percentage of the PBT or profit before tax. In March 19, the company had paid a tax rate of around 32.1% on its profit earned before deducting the tax itself. So in March 19, the company's profit before tax was 1015 crores. On that it paid a tax of 325 crore. So that's a 32.1%. But recently the government has reduced the tax rate, so maybe that will get reflected in the next year. Next, let's look at the interest coverage. This is the comparison of the interest paid against the company's earnings before interest and tax was deducted. So here we are looking at the EBIT and seeing how much it is more than the interest it has to pay. So we want the interest coverage to be at least 4 times, meaning the EBIT should be at least 4 times more than what the company is paying as interest expenses. In this case, in this particular company's case, the interest cost is interest coverage is very high and at a very comfortable position, so there is nothing to worry about. The company in March 19 had an earnings of around 1036 crores. This is the operating profit plus the other income less the depreciation. So when we see at the EBIT value, EBIT figure, it's 1036 crores, against which the company paid an interest cost or a finance cost of just 21 crores. So company can very easily pay off the interest cost using its EBIT. And in March 19, the multiple was around 49.5 times, meaning the EBIT was 49.5 times higher than the interest it had to pay. Next, let's look at the net profit margin since March 15 till March 19. The company has been consistently increasing its net profit margin from March 15 till March 19. In March 19, it managed a very a comfortable 21.8% of NPM, which is an excellent figure. So in March 19, we see the company's sales were 3,161 CR, against which the company's net profit was 690 crores. So that's a 21.8% of NPM, which is a good value. Even in the recent 12 trailing months, the NPM is quite high at 19.24%. The average NPM, just like the average OPM, helps us understand what is the net profit margin the company has been earning from last 3 years on average, last 5 years on average, last 7 years and 10 years. So we'll be just analyzing the 3 years and the recent data. Last 3 years the company's average NPM has been at around 19.5%, and even in the recent 12 trailing months it's at 19.2%. So this is a very good value. Anything above 10% of NPM is a good figure. Next, let's look at how the company has managed to grow its profit. Just like sales growth, we also need to look at how the company is growing its net profit. So from last 3 years, the company's profits, that is net profit, has been growing at a very healthy rate of 46.38%. And as we can see, from 10 years, 7 years, 5 years, 3 years, the growth has been consistently going up. So in 15 it was 228 CR, net profit was 228 crores. March 16 it was 220 crores. So for 3 years growth rate, we need to take data from March 16 till March 19 and see that the net profit was 220 crores in March 16, which increased to 690 crores in March 19. So that's a compounded average growth rate of 46.38%, which is very good. Now, one thing we need to keep in mind, whether this net profit includes extraordinary items, and if it does include, then we have to remove it out for our calculation. Many times this extraordinary items or exceptional gains do inflate the net profit, or sometimes even deflate if there is an exceptional loss that takes the profit down. So we need to adjust that one time gain. Like, say if the company is selling its subsidiary, then it would receive money because of those sales, because of that sale of subsidiary. And if the company has sold and at a loss, then that loss will get reflected, but it's a one time gain or one time loss, so that needs to be removed out from the net profit calculation. But in this case, the exceptional items have not been removed, and this includes the exceptional gains, if any, in the analysis. Next, let us look at the valuation ratio, market cap to sales ratio, which will help us understand how far away the company's market cap is compared to the sales. So we see that in March 19, the company's market cap was just 1.15 times more than the sales it did. So in March 19, the company's market capitalization, or the total value of the company in the market, was around 3,623 crores, against which it managed the sales of 3,161 crores. So this is very good. So we want to buy into a company when the market cap and the sales are very near to each other. For example, in March 18, the market cap increased to 2 times of the sales. That is, market cap was at around 5,130 crores and the sales was at 2,455 crores. So that's a multiple of 2.09. Although this is also very good, I would even want to buy when the market cap is, say, 3 or 4 times more than the sales. That is still a reasonable valuation, but very high valuations, or in terms of market cap to sales, then that's a expensive buy according to me. Dividend payout. How much of the net profit was paid out as dividend to the shareholders? This is just a cursory look. It does not help into analysis, but it's good to understand how the company looks after the shareholders' interest. So the payout has been consistently decreasing from March 15 till March 19. In March 15, the company paid 14% of its profits as dividend, which decreased to 8.52% in March 19. So, in March 19, the company's net profit was 690 crores, but it paid only 59 crores as dividend, and the balance it kept in its profit into the business, maybe for growth, maybe for acquisition, for anything else. But the most of its profits were left over in the company itself. Next, let's look at the price to earnings ratio. This is also a valuation ratio which helps us understand how far away the price is compared to the earnings per share of the company. In March 19, the price to earnings ratio was somewhere around 5.25 times, whereas in the recent 12 trailing months or the latest price to earning is 4.97 times. So this is a very low price earning multiple that we can pay for this company. Since March 15, we can see that it had been increasing and went up till 9.72 times, meaning the earnings per share in March 18 was 72.85 paise per share. This is the profit per share basis, and the price at that time was 698 rupees. So that comes out to a multiple of 9.59 times. In the recent 12 months, the price or the latest price earning multiple is at 4.97. The company's earnings per share has increased to 80 rupees, and the price has also come down to 401 rupees. So now it is much reasonable and a good buy if we take it in terms of price to earnings ratio. For me, anything below 25 times is a good multiple. Again, we have to cross compare it with the peer group companies and see where the peer group companies are trading at what price earning levels those other companies are available at. But nonetheless, this is a very good price earning multiple of 4.97 times. Let's look at the average price earning. Since last 3 years on average, the price to earnings was at 8.19 times, and the recent we saw was 4.97. So even in terms of 3 years comparison, the latest price earning multiple is at a discount of almost 50% to its 3 years average. In fact, even through 5 years average also, the current price earning is below that. So this is a good buy if we take it in comparison with 5 years average and 3 years average. So that concludes our analysis of the profit and loss account. Let's move on to the balance sheet analysis. The equity share capital, this is the initial share capital that the company started with. So it's at 73 crores throughout. So there is no dilution as such. Not more shares have been no additional shares have been added into the company. That is a very good thing. We don't want the companies to add in more and more shares and raise more and more money. So if the company is adding up more shares every year, basically that dilutes the profit that goes to each shareholder. So this is good. We want a stability. We want to see a stable equity share capital. Next, let us look at the ROE or the return on equity. It is calculated by comparing the net worth with the net profit. Net worth is the equity plus any reserves and surpluses the company may be having. So that's the total net worth of the company in this case. So against that, how much on that net worth, how much profit the company is generating every year. That is return on equity. In March 19, the company generated 16.1% on shareholders' money. This is also known as shareholders' equity. So 16.1% is good. We want it to be at least above 15%. But as we can see from March 15 till March 18, the ROE was below 15%. And only in March 19 it has increased to 16.1%. So individually, figure wise, the total net worth of the company was 4,297 CR, against which the net profit stood at 690 crores. So that's a 16.1% return on the net worth. Return on capital employed, or ROCE. This is calculated by comparing the EBIT, or what was the top line profit the company generated, against the total capital employed. In this case, capital employed is a total of the net worth plus any borrowings done by the company. The ROCE should also be above 15% at least. Since March 15 till March 18, we can see that the company's ROCE was below 15%. Only in March 19, the value has jumped to 22.8%. And March 19, the total capital employed into the business, that is the debt plus the equity, was around 4,544 crores, on which it managed to generate 1,036 crores of EBIT, that is the earnings before interest and tax. So that works out to a 22.8% return or profit, top line profit generated on the capital employed. This is very good. Next, let us look at the return on assets, or ROA. Here too we want it to be as high as possible. This is calculated by comparing the net profit against the total assets employed. Total assets is the total balance sheet size. What is the asset side total or liability side total? That is the total assets in this case. And we want to see how much net profit the company managed to earn on its balance sheet size. Again, is the same trend, upward moving trend. In March 19, the company's ROA has increased finally to around 12.2%, which is the total assets in this case is 5,635 crore. This includes the debt, the equity, plus any other liabilities that the company may be having. So, or we can even consider all assets of the company in this case, because the total of the balance sheet on both the asset and the liability side is the same. So whether we take the asset side or the liability side, the total is 5,635 crores in March 19, on which it managed to earn a profit of 690 crores. That's a 12.2% return on total assets of the company. Let us look at the average ROE for 7, 5 and 3 years, and average ROCE for again 7, 5 and 3 years. Return on equity since last 3 years on average stood at around 13.1%, and return on capital in last 3 years on average stood at around 13.7%. So we want the average ROE of 5 years and 3 years, even in fact ROCE as well of both 5 and 3 years, to be above 15%. So that shows us that the company is generating a healthy margin on the total capital employed and total equity employed. Let us look at the net worth as a percentage of total assets, meaning of the total balance sheet size, how much was occupied by the equity portion and how much was occupied by the debt portion. So in this particular graph, we are concerned with net worth percentage as of total assets. So in March 19, the company's equity portion or shareholders' contribution was around 76% to the company's balance sheet, which is very good. We want this to be as high as possible so that the debt portion remains low. In this case, of the total assets of 5,635 crores in March 19, 4,297 is contributed by the shareholders, either in terms of equity or retained earnings of the past years. So the total return or total net worth of the company stood at 4,297 crores. This is a value contributable to the shareholders. Next, we'll look at what is the borrowings percentage as of total assets, meaning of the total assets, how much was purchased from borrowings done by the company. So we see in March 19, the total borrowings were very low at just 4% of the total assets, meaning most of the company or rather the company is working mostly on shareholders' money rather than on borrowed money. So this is what we should be looking at, that the company has a good mixture of borrowings and retained earnings. In March 19, the company's assets, total assets as of balance sheet size in March 19 was 5,635 crores, on which the company's borrowings were just 247 crores. So the borrowings or debt was a very small portion of the total assets of the company. Now let us compare the debt with the equity or the net worth with the borrowings that we just saw earlier. Here we want the debt to equity ratio to be below 1 times, meaning debt and equity can be at least equal, but the debt portion should not be more than the equity until and unless there is a good growth visibility in the company, and then the company can borrow money and fund its acquisition or growth through that borrowed money, provided again that that borrowed money is not at a very high interest cost. So in March 19, the debt to equity was a very low at 0.06 times, meaning debt was just 0.06 times of the equity contribution. Value wise, if you look in March 19, the company's total equity contribution was 4,297 crores and the borrowed money was just 247 crores. So there's a very good difference, meaning the company is working on the shareholders' money rather than on the borrowed money. Next valuation ratio we are looking at is the price to book ratio or PB ratio. This ratio tells us what is the company's market capitalization or what is the value of the company in the market against what the company is actually worth on the balance sheet. As we saw in March 19, the company's net worth was indicated in green, so I have color coded this. Market capitalization is in blue and net worth is in green. So the company's market cap in March 19 decreased to 3,623 crores from 5,130 in March 18. It dropped to 3,623 crores in March 19, against which the company's net worth was more than the company's market cap, meaning we are getting it at a good discount of 0.8 times, which again means the company's market value has fallen below the actual value of the company on the books. So this is the right time to buy, provided the ratios or the fundamentals of the companies are intact. We don't want to buy into company with a bad fundamentals even if you are getting at a very low price. So consistently it has been trading, if we see even March 15, 16, 17, it's been trading at a discount to its net worth throughout these 3 years. In March 18 only it increased above its net worth, but again came down to 0.8. The recent price to book, this was the March 19 data, and the recent or the latest price to book ratio is at 0.7 times, meaning the total net worth, again in this case net worth we have to take is of March 2019 and the market cap is of the as of today. So today's market cap is at 2,950 crores. This is the value at which the company is available in the market if someone wants to buy, and this is the actual net worth of the company. This is what the company is showing that it is worth in its balance sheet. So this is a good discounted price that we can buy it at. Let us look at the current ratio, which again helps us understand what is the total assets or other assets, or rather current assets, that the company has on its book against the current liabilities it has to pay in this year. The current assets and current liabilities are those assets and liabilities which the company has to either pay or receive in the current year. So we want the company's current assets to be at least equal to current liabilities so that it can pay off those liabilities which will be arising in this year with the current assets that it has on its book by selling those. So we want the current ratio to be more than 1 times, meaning other assets or current assets should be more than the current liabilities. In March 19, in fact, even if through 15 till 19, the company's assets have always been more than its liabilities, and it was always in a comfortable position. Even if it had to pay all its liabilities in March 2019, that was around 1090 crores of liabilities, current liabilities, it could have easily paid, or it would pay easily using its current assets of 1960 crores. Next, let us look at the net block percentage. Net block is the net assets of the company. These are the fixed assets or tangible assets, including the intangible. So these are the assets of the company, and we want to understand how much these assets, fixed assets, are occupying as a percentage of total balance sheet size or the total assets of the company. We don't want the company to invest too much into assets until and unless it is a very capital intensive and asset intensive business. So here in this case, the company's asset as a percentage of its total balance sheet size is around 41% consistently, or rather from 55 to 41 from March 15 till March 2019. So this is again a steady value. The company's fixed assets have been always at this percentage rate of the total assets. So in March 19, the total assets were 5,635 crores, or the balance sheet size was this, against which the assets or fixed assets were that occupied the balance sheet was around 2,300 crores. And value wise, if you see, the assets have been increasing steadily but in a consistent manner. This is how we want the assets to increase. If there is a growth in the company, it's okay, but then the growth has to be in a systematic manner. Let us look at the capital work in progress percentage. Again, this is the total assets which will be getting added, but yet in progress the work is going on those assets, and they have not been transferred to the net assets or net block of the company. So this is a part of the net block which will be added into net block as and when the work is finished on those assets. So capital work in progress as a percentage of total assets is just 5%. So only 5% of the total assets, or there is work going on in terms of fixed assets on 5% of the total balance sheet size. The total balance sheet size is 5,635 CR, against which the work in progress, or capital work in progress rather, is only 307 crores. So we can expect that an additional 307 crores of assets will get added to the net block, which we saw earlier in the previous graph. Investments as a percentage of total assets. Investments, we don't want a big chunk of the balance sheet to be invested, or rather, if there is a lot of excess fund in the balance sheet, those can be invested, but not a major portion of the balance sheet should be occupied by the investing activity. Rather, we would want the company to grow by doing acquisition, or even returning the money back through doing buybacks or giving bonus or dividend and so on. So too much of investments, if done by the company, then that doesn't serve the purpose. And on the other case, if it has cash and it doesn't want to pay back to the shareholders, then it can do investments and use the additional income to fund or to increase its net worth. From March 15, it was just 6% of the total balance sheet, but from 16 onwards, it has increased to double-digit figure of around 21%, 22%, and 19% in March 19. So the investments is occupying approximately around 19% of the total balance sheet. Let us understand it value-wise. In March 19, the total balance sheet size was 5,635 crores, on which the company's investments were itself around 1,066 crores. Now these investments are generally into mutual funds or bank deposits or something of similar nature, whereby it can earn other income or other it can be another source of income for the company. As mentioned again earlier, we don't want a major portion of the balance sheet to be occupied by the investment part. Next, let us look at the inventory percentage. Again, we want to see how much of the total assets, or rather how much of the total assets was occupied by the inventory part of the balance sheet. So the inventory is just 4% of the total balance sheet size. Inventory is basically the work in progress on the goods being manufactured in the company, and we don't want a very high inventory on the books, because that can lead to higher working capital requirements, and as fast as possible the company should be able to dispose of its inventory and not keep a holding of that. So 4% is a very good value. The company's total assets were 5,635 crores, against which the inventory was just 231 crores. So this is a good value, and consistently it has been at this value from 15 onwards. And the total assets also has been growing. The balance sheet size has been growing from 3,000 crores to 5,635 crores in the last 5 years. Next, let's look at the debtors as a percentage of total assets. Debtors are customers from whom the company has to still collect payment for the credit sales it did earlier. So we don't want the debtors again to occupy a big portion, as that blocks the capital for the company, which can be used either in investing or for the growth of the company. In this case, in March 19, the debtors were just 9% of the total assets, meaning that only 9% of the total assets, or rather we can see value wise that the total assets were 5,635 crores and the company had to collect 487 crores from its customers. So that's a mere 9% of the total assets. We don't want this to go at a very high figure of say 30% or 40%. Next, we'll look at the sales to debtors percentage. This ratio basically helps us understand whether the debtors as a percentage of sales is very high or low. In March 19, the sales to debtors percentage was just 15%. We don't want the debtors to exceed 30% of the current year sales. I'll explain this in terms of individual values. In March 2019, the company did manage to do a sales of around 3,161 crores, against which it had to collect from the balance sheet. We got this value of 487 crores that the company had to collect from its customers. So as a percentage of sales, the amount the company had to collect from its customers was just 15%, and this is a good value. We don't want a very high value, and we can see consistency also in terms of collection throughout March 15 till March 19 at around 16%. And value wise also we see there is a steady collection, or the company has managed to keep its debtors at a reasonable percentage to its sales. As I mentioned earlier, we don't want the sales to debtors to exceed 30%, meaning debtors should not be 30% of the current year sales. Next, we'll look at the debtor days. This ratio helps us understand how fast or within how many days the company is collecting payment from its customers. In the earlier chart, we saw how much was pending to be collected, and in this chart we'll look at within how many days it is collecting those pending payments. So in March 19, the company is collecting payment in 56 days, and it has been throughout like that: 57, 60, 58, 60 and 56 days in March 2019. I don't want the debtor days to exceed 90 days. That is, the collection period should not exceed 90 days, as that would again put pressure on the company's working capital requirement or daily requirement of capital. So it's better the company collects as fast as possible from its customers. So individually, if you look at March 19 data, The total sales of 2019 were 3,161 crores, against which the company had to collect 487 crores of payment from its customers. So to calculate the debtor days, we divide 487 by 3161 and multiply by 365 days. So that gives us number of days the company is taking to collect payment from the customers. Inventory turnover. This ratio helps us understand what is the inventory level in the company's books or on the balance sheet against the sales it did in that year. So we want the inventory turnover to be as high as possible. So in March 19, we see that the company's sales were 3,161 crores and the company's inventory were just 231 crores, meaning the sales were 13.7 times higher than the inventory holding. And we see again a consistency of around 10 times, 12 times, 9 times and 13 times. So sales was high at around 10 times to 13 times. So this is a good value. Again, we want to see a consistency in the numbers as well. This completes our analysis of the balance sheet, and we'll move on to the cash flow statement analysis. So we'll begin our cash flow statement analysis by looking at the cash earned from, or which went cash going into the operating activity. So we'll understand how much cash has the company actually received through the operating activity of the business. You can refer to my cash flow from operations video which I made to understand what exactly this is and how to compare it using the PBT, or how to compare the cash flow from operations with profit before tax value or net profit value. In March 19, the cash coming in through business activity or operating activity was around 838 crores, and it has been consistently growing from March 15 till March 19. In terms of cash coming in or going into investing activity of the business, in March 19, 580 crores went into the investing activity. So the company has earned 838 crores in cash from the operations of the business and has spent 580 crores in the investing activity. Investing activity are those activities like buying or purchasing of fixed assets, or investing in mutual funds or deposits of the banks, and so on. So I generally would not like companies investing activity to exceed the cash it has earned in a particular year. So as an example, in March 17, the company has earned a cash of 503 crores through operations, and in March 17 it has invested 468 crores. So it has consistently invested less than what it has earned through operating activity. Finally, we'll look at how much cash has come in or went into financing activity or through financing activity. Financing activity are those activity like paying of dividend or repayment of loans or doing buyback. All those activities are classified under the financing activity. So either the cash can come in or can go out of the financing activity, just like in investing and operating activity. So in March 19, company has spent 136 crores in the financing activity. If we want more detail of this, then we will need to look at the annual report of 2019 to understand the detailed cash flow statement, to understand what the company has spent this 136 crores on, whether it has given dividends or done buyback, bonus, what exactly has it done with this 136 crores. Can't be understood by just looking at this number. We can do a detailed analysis if we look at the cash flow statement in the annual report on the company's website. Finally, after doing all this activity, how much cash, net cash, is left over with the company? In March 15 till March 18, it was very less at just 49 and 3 crores. In March 19, the net cash flow increased to 122 crores. This is the final cash that the company had on its book after doing all these three activities. Now this is an important ratio to look at. We want to understand the profit that the company declared before paying tax, and how much of that profit has actually got converted into cash or has come in cash. So if the company has declared a certain profit, we want to understand how much of that profit is actually received by the company in its hand or in its bank by way of cash, whether the company has received money or it's just a paper money. In last 3 years, the total profit that the company declared was around 2147 crores. This is the 3 years total profit before tax value, and the green is indicating the total cash earned in the last 3 years through operating activity. So that is a 86% of cash coming in against the profit declared. So we want the cash to be very near or even higher than what the company has declared as profit. So that signifies that whatever the company is saying that it has earned as profit is actually being received in terms of cash. In the last 5 years, that value was at around 90%. So the company's 5 years total profit before tax value was 2625 crores, and the company managed to convert that into cash by a figure of 2352 CR. That's a 90% conversion rate, which is good. And in the last 7 years, the conversion rate was 94%. Next chart on the right hand side, we are looking at how much of the cash the company has earned through operations and how much it is investing in the investment part of the business. So as I mentioned earlier, I don't want the cash earned through operations, or rather the cash the investing activity of the company to be more than what it has earned through operating activity of the business. The cash coming in March 19, or rather the cash coming in the last 3 years was 1856 crores, which we saw earlier in this graph also, that the company managed to receive cash of 1856 crores in the last 3 years. Of that 1856 crores, it has invested 1444 crores either in fixed assets or done investment activity like buying of mutual funds and all those things. So that's a 78% 78% of the cash earned in the last 3 years was invested in the investing activity part. In the last 5 years, the percentage was around 85%, and in the last 7 years, the company's total profit was 3000 crores and 2392 was invested back into the assets and the other activity. So that's a 79% of investments done by the cash, or rather whatever cash was earned in the last 7 years, 79% of that was invested in the investing activity. As I mentioned earlier, we don't want this value to exceed 100%, meaning more investment should not be done than what the company is earning by way of cash. So that concludes our cash flow statement analysis. Finally, we'll look at the quarterly profit and loss account analysis. We'll begin by looking at the sales growth YOY, that is year on year, that is from September 2018 to September 2019, direct comparison. And then we'll look at the profit growth rate, or we'll look at how the profit has changed from September 2018 to September 2019, as well as from quarter on quarter, that is from June 2019 to September 2019 for both sales and profit. So let's begin with the sales growth, or how the sales has changed year on year. So YOY, the sales has declined by 9.4%. That is, in September 2018, the sales was more than what it is currently. In terms of quarter on quarter, that is from June to September, also the sales has fallen. So basically the sales in the September quarter has gone down below both June quarter of 2019 as well as the September quarter of 2018. So we don't want generally to see a negative value, that is degrowth in sales, because that basically affects the overall performance of the company as well as it affects on the share price. If the company's sales are dropping, that is basically pressure on the company's demand, and therefore the shareholders or the market participants would dump the stock in the market if either the sales or the profit drops. At one point of time, even if the profit drops, it's okay, but the sales generally should be continuously going up. That shows that there is a consistent demand for the company's goods. The profit also has seen a degrowth of around 41.4% YOY from September 18 to September 19, and from June to September it has seen a 35% drop in its net profit. So the profits have also fallen along with the sales. So there's definitely some kind of margin pressure in the short term, but in the long term overall the numbers are very good. So we can continue staying with this company if we want to. Let us look at the net profit margin. In September 18, the margin, that is the profit earned on total sales, was around 22%, and it has been consistently at that till June 2019. In September 19, that is the current quarter, it has dropped to 14%. So there is quite a margin pressure on the company's quarterly report. In September 19, the company has done a sales of 698 crores, way below the last 4 quarters, and in fact the profit has also dropped considerably from what it was earning in the last 4 quarters. So the margin overall has dropped to 14%. So that concludes my analysis of Gujarat Alkalies and Chemicals Limited. Thank you for watching this video.